Hi, I'm Rajeev Radhakrishnan. I head the fixed income team at SBI Mutual Fund. Today, I'll just talk you through the recent happenings in the bond market and our positioning of funds on the bond space. There are a couple of reasons for these market developments. The first would be post Brexit. There is a sense that global monetary policy would remain easier. You might see additional QE by global central banks, and the Fed policy stance also to that extent would be far more cautious in terms of their further adjustment in policy rates. Secondly, on the local market side, after Dr. Rajan's exit, there is speculation in the market that the replacement of Dr. Rajan would be someone who would be far more dovish. So to that extent, there is a sense in the market that incrementally the RBI's policy space could be opened up further in terms of additional policy accommodation. But more importantly, on the domestic side, what has really changed is the liquidity scenario. As you are aware, the RBI is transitioning from a deficit liquidity to a neutral liquidity stance. To that extent, they have conducted open market operations over the last quarter. But from June onwards till early part of July, we have seen a significant inflow of funds back into the system. Overnight rates have been significantly lower than the policy repo rate, and to that extent, with overnight funding costs being substantially lower than the policy rates, again that has added a further fillip in terms of incentive, or rather bond market participants have been far more aggressive with these developments. So there are these couple of factors that have sort of pushed down bond yields. We expect the next couple of months at least liquidity in the system should remain neutral or marginally in surplus mode. But as you get into September with the FCNR outflows, we need to really figure out as to how liquidity pans out. But for the next couple of months at least, broadly liquidity situation seems to be broadly positive. As regards the global situation, again it's more likely that global central banks should be slightly on the dovish mode. So as regards the direction of bond yields, we still hold on to a view that at this point in time, based upon what macro data that we have, based on especially the CPI trajectory in the near term, there's very limited scope for incremental policy easing. Direction of bond yields, I think, would largely be a function of how the system liquidity pans out and to what extent there is credit demand in the banking system. So we're fairly positive on a medium-term liquidity situation because the RBI would keep liquidity at neutral. And incrementally, we're not really seeing credit demand in the banking system at this point in time. So we are not really not saying that there is a negative outlook on bond yields. So we still maintain that over a period of time, the trend for a steeper curve would persist. Bond yields will retrace gradually depending on the liquidity scenario in the market. As regards our funds, definitely there has been a momentum which we've actually been playing out in the sense that with these developments over the last couple of weeks in our long-term funds, we have increased our duration. So if you are aware, in the past, in the last couple of months, we've benefited significantly from our positioning in tax-free bonds. That's really made money incrementally because market momentum is very supportive. We've actually, on a very tactical basis, shifted our duration slightly higher across our long-term funds. But we've largely stayed in liquid bonds to the extent that one needs to have the flexibility to react to market developments. So on a medium-term framework or a medium-term outlook, I still believe that we are in for a relatively steeper curve. To that extent, I think the short end of the curve, which is up to the 10-year space, I think that should do well. So over a period of time, that's a space where we would largely stay invested. Of course, tactically, we have increased duration to take advantage of near-term market developments. We've been staying closer to our maturity caps in most of the other short-term fund categories. So this is the position that we would continuously review depending on our views as regards how market developments are panning out.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.